What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and right now in Japan, it looks like they are losing the battle between either the value of their currency, as their currency is in a free fall right now, absolutely collapsing, and on the other side, the value of their 10-year government bonds. The yields on these bonds are pushing against the upper bound. They've been trying to keep the interest rate at 0%, and it looks like they are about to fail, and market forces are going to overcome their yield curve control. So we are going to dive into exactly what that means, what is going on, and what it might mean for you. Ready? Let's dive in. In these crazy, volatile financial times, there's no better time to dollar cost average into Bitcoin, also known as stacking sats. You know I've talked about Swan Bitcoin many times on this channel because they're my favorite way to stack sats. They're the easiest, they're the cheapest, and they're the most secure. They auto withdraw to a wallet of your choice. I buy Bitcoin literally every single day using Swan, and if you use my link in the description below, you will get $10 worth of Bitcoin for free just for signing up. And big thank you to Swan for sponsoring this video as well. All right, let's jump in here and look at what is going on in Japan across the pond right now. Japan is fighting two big battles. Number one, their currency is in an absolute free fall. We can see for the last few weeks, it has just been collapsing. And as a side note, you see that purple line there? I drew that purple line a long time ago. I have no idea when I drew that, but it's pretty funny because, you know, a lot of people say technical analysis is voodoo, and for one reason or another, it just happens to be that it broke down below this purple line, which was support and resistance for a long time, tested it again, tried to break up above, and when it finally failed, man, it started to fall very quickly. And so we've seen the yen just start to absolutely collapse. And so today what we are going to look at is that battle that they're fighting on one hand, and part of the reason why is because of the battle that they're fighting on the other hand. Japan has been involved in yield curve control, outright yield curve control, not the hidden, the attempt, the implicit yield curve control that we've seen from other central banks like the Fed. Instead, it is outright stated yield curve control. And so they're fighting that battle, trying to keep the yield on their 10-year bond at zero. Now, there's a range, obviously, because there are free market forces that they have to combat. And so there's a range, and it has been butting up against the upper end of that range, despite the fact that they are trying to fight it with everything they have. So, first of all, getting most of these charts from Jim Bianco at Bianco Research on Twitter. I will post his original thread in the description of this video. If you'd like to take a look at that, be my guest. He's a great follow on Twitter. Second, we have to talk about exactly what yield curve control is. So, starting off, we have to understand very basically what a bond is. Let's say I have a magic box here. I have this magic box that will produce for you $101. It's a box. In 1 year, it will produce $101. What would you pay for this magic box? One time at the end of the year, it'll give you $101. Would you pay $110 for it? Probably not, because then you'd lose $9. You're paying $110 for this, but it's only going to give you $101. You're going to lose $9. Not a good deal. Would you pay $100 for this in a year? Maybe. I mean, you might as well buy something else, though, that you can use in the meantime, because by the time this thing gives you $101, anything that you might have tried to buy for $100 might cost a lot more because of inflation. So you might still lose purchasing power on that. So maybe you buy this for $90 because you know it's going to give you $101. So you get a nice little 10%, just about 11% on your money. You buy this for $90. In a year, you get $101 back. Magic box. That is what a bond is. A bond is basically an agreement that gives you money back plus a little bit extra at a predetermined time. So the entire market is looking at all the bonds available at any given time and trying to figure out whether it's worth it or not, to give them some money, and at the end they'll get some money back to know whether that's worth it or not. Maybe they should do something else with their money. That's it. That's all it is. And so whatever the price is, of that bond will determine what the yield is, how much you get back, what the percent, what the return is. That's it. So when you're looking at all of the bonds, like let's say this 10-year bond in Japan, you've got a lot of people looking at it right now, and they're selling it because they're saying, hey, look, inflation's taking off, and right now it's yielding 0%. And so if I buy this, in 10 years, I get back exactly the same number of dollars that I gave, but prices will be higher. That's a bad deal. I don't want to hold on to it. So they're going to sell it. What's the other thing that we know about prices? Prices are an auction. That's how prices are arrived at, is a massive auction that is taking place continuously all throughout time. And so you have all the buyers and all the sellers coming together, auctioning back and forth, negotiating with each other, trying to figure out a reasonable price that they can come to an agreement on and make the transaction happen. So when you have a bunch of people that are looking at something, let's say like this magic box, this 10-year bond, and saying, nah, I don't want any part of that, they're going to start selling it. So that's a lot of selling pressure. That means anybody who's coming in to buy will kind of have the upper hand here, because they're going to be able to get it at a lower and lower price. If you've got a bunch of people wanting to sell something, they're competing for the buyers. And so they're going to have to compete with lower and lower prices. The buyer, there's very few buyers, let's say, they're going to come in, they're going to say, I don't want that for 90 bucks. Maybe I want it for 80 bucks. Maybe I want it for 70 bucks. So they're going to have the power if there's less buyers and more sellers. The sellers are competing for those buyers. On the opposite side, let's say there are more buyers than there are sellers, then it's going to go the opposite way. We've seen this in real estate over the last couple of years. You've seen a lot more people come in to buy than there are houses to be sold, and so the buyers are competing with each other for the seller, and so that's driving prices up, because the seller can be choosy. They can say, hey, well, maybe I want to sell it for higher, maybe I want to sell it for higher. And so when you have a dynamic where yield curve control comes into play, a central bank is basically saying, I will compete with all the sellers no matter what, because we know that the interest rate and the price is inversely correlated, right? On a bond, if everybody's selling it and it goes to 90 or 80 or 50, it's still going to pay out that 101 at the end. And so that price being driven down will drive those yields up. So if we take a look here at the chart from the Bank of Japan here, we can see this is the 10-year yield. The blue line is the actual yield, and then these gray boxes are where the Bank of Japan wants to keep the interest rate. And so they want it at 0%, but there's going to be a band. And so this band that they want to keep it in is 1/4% to the upside or to the downside. That's 25 basis points, 25 bips. Used to be a lot tighter of a band there. And so now they're, 25 basis points to the upside and to the downside. So they've got a bunch of, this is the interest rate going up, the yield is going up. So they've got a bunch of people selling this because everybody's looking at this and saying, I don't want to get 0% back in 10 years, so I'm going to sell this. And so everybody's selling. But yield curve control is fundamentally different than something like quantitative easing. The Federal Reserve has been doing quantitative easing, as have other central banks for many years. What that is saying, hey, we're going to buy a specific number of bonds. The interest rate will do whatever it wants. We're just going to be a big buyer. So the Federal Reserve was buying $80 billion worth of U.S. Treasuries every single month since COVID started, since like April or May of 2020, until they started winding down that program just a couple of months ago. And so they were buying $80 billion worth a month. Now, if everybody else starts to sell, it's still going to have an impact on the interest rates going higher. Maybe more than 80 billion is being sold by other participants, so that $80 billion that the Fed is buying might not be enough to fully counteract all the extra selling. Yield curve control, which is what the Bank of Japan has been doing, is fundamentally different. Yield curve control is targeting an interest rate, not a specific number of bonds being purchased. So when you see yield curve control, where they're saying, hey, we want the interest rate in here, that means that they're not targeting a specific number of bonds to be purchased or sold. They're targeting the interest rate. That means whatever quantity of those bonds is necessary to be bought to achieve that interest rate will have to be bought. And so you could have literally the entire world start to sell their bonds, and the Bank of Japan would have to look at this and say, we have to create enough money out of thin air to buy as many of those as possible to make sure that the price doesn't dip down below a point at which would cause the interest rate to be above 0.25%. So when we look at the Japanese yen, we can see that's why the yen has been cratering, because they're fighting this losing battle where if the entire world decides, hey, we want to get rid of these, they have to keep on creating more and more of these in order to buy them. Now, what's that going to do to the value of the thing you're creating out of nothing in order to buy? It's going to make that value go down. So not only are you struggling with losing value in your currency, but you're also struggling with trying to stop this rise in yields from happening. And so you are at the same time, you're making this problem worse by fighting this problem. And if they turn around and try and fight this problem to send the yen back up, then they have to let go of this, and they're going to see interest rates on their 10-year explode. Keep in mind, this game has been played countless times throughout history, and it always ends in failure. It's never successful long term. A very famous example of this is John Law's Mississippi bubble. He backed his currency with some gold, some silver, made everybody use paper currency, but the majority of it was backed by the Mississippi Company, shares of the Mississippi Company. And when the value of the currency started to crater, he needed to keep the value of that currency high. So it was backed up by the Mississippi shares. So he said, hey, we need to make sure that those shares stay high so that it keeps the value of the currency higher. So he printed more currency to buy more shares of the company to keep that elevated. But that means that you're just printing more currency, which pushes downward pressure on the value of the currency. The smart people who recognize this got out of the currency. They bought gold and silver, waited for everything to collapse and crash. And ultimately, that's exactly what happened. So this game has been played many times before, and it doesn't end well. Now, the other thing to keep in mind here is look at how far the value of the yen has dropped, this massive drop here. And historically, it's almost never fallen this dramatically. We had a big drop back in 2016 before they started yield curve control. You can see here. But other than that, it rarely moves this fast, this quickly, and this severely. And even despite the fact that they've done all of this to combat rising rates, look at that. It's still at the upper end of this band that they want to stay in. So they haven't been successful at bringing those yields back down, despite the fact that they've been absolutely destroying the value of their currency. So you might be asking, okay, well then what? Why does this matter for me? And this matters actually for Americans very much, because the value of the yen is highly correlated to the value of the US Treasury, and here's why. Japan is the biggest holder of US Treasuries. They hold more than China does. You can see here Japan owns $1.31 trillion worth of US Treasuries, whereas China only owns $1.05 trillion. Now, obviously, that doesn't hold a candle to what the Federal Reserve owns, but Japan is outside of the Fed, is the largest holder of US Treasuries. Now, since they are such a big holder and big buyer, number one, their buying of Treasuries has had to dry up because they have to print more money in order to do this, and they've been fighting their battles. So the 10-year Treasury has been absolutely skyrocketing over the exact same time period as the yen has been falling. We can see that overlaid on this chart right here. The 10-year yield has been spiking right along with the collapse in the yen. And the tough thing about it is that Japan is in a much worse position right now than they were a couple of weeks ago when they started aggressively having to buy their bonds. You can see here, it was a lot easier to do it when the value of their yen was higher. And now that it's lower, they're having a much harder time. It is more expensive to perform these same defensive actions. And yet they are in the exact same situation as they were a couple of weeks ago. The situation has not improved. So this would be similar to Apple trying to artificially keep the price of used iPhones very high. And they put something out and said, hey, we're going to buy all used iPhones for $2,000. Doesn't matter how many of you want to do that. We want the price of used iPhones to be $2,000. So if anybody wants to sell us their iPhones for $2,000, we will. But at the same time, let's say they didn't have a cash balance bigger than the United States Treasury. Let's say they had a cash balance that was only big enough in order to purchase half the world's iPhones. Well, that's a pretty big incentive you have out there to sell you something at a price that's way higher than what it is intrinsically worth. So everybody's going to be selling you their used iPhones for $2,000. And if you don't have the cash to back that position up, means you're going to run out of cash. That's exactly what's happening here with the 10-year bonds. Everybody's looking at this and saying, hey, in the free market, this would be worth a lot less. Right now, we've got a buyer that's willing to buy them at a way higher price than what they're intrinsically worth. And they're saying an unlimited amount of these they'll buy. We're going to sell absolutely as many of them as we can. That's exactly what is going on here. So sooner or later, the market forces will likely, not definitely, but will likely overpower the Bank of Japan's ability to defend either the currency or yield curve control. And given the fact that Japan is the largest holder outside of the Fed of the United States Treasury, that means number one, they are not buying as many as they were before, which is helping to drive yields higher. And number two, if they have to start selling them, that will drive yields up even higher as well, could force other central banks to have to reverse course, the Federal Reserve to stop tightening, to start buying those bonds up from the Bank of Japan. And ultimately, if rates get pushed up even faster here in the States, we could see some major things blow up in the commodity markets. We could see margin calls. We could see some real estate troubles. There's all sorts of things that could start to crack as a result of this. But those are all topics for another video. And finally, I'm going to be speaking here at the Market Disruptors Live Conference in Dallas in just a couple of weeks, actually just a couple of days away from now. We are going to be having a great time there. There are a ton of good speakers. I would love to see you there. And if you have the ability to join, I've got a link that you can use to sign up in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.